3 p.m. Eastern Time. Welcome back to the final hour session. Chris Pulver here just after 3, June 11th. Happy Wednesday. CPI data came out for the U.S. today. We'll take a look at the numbers. Rumor mill is swirling that Trump is already looking for a replacement to Jerome Powell when at least his term is up in, I believe, May of 2026. A couple names come through, but one stands out. That would be Scott Bessent. We'll see if that's the kind of silent Fed chair in the interim. If the current Fed with Powell and company stay firm on not touching rates until September of 2025, what do the markets do this summer? Let's take a look at inflation data today. Here's the economic calendar for Bloomberg. 8:30 a.m. Eastern Time news came out. 2.8 was the expected year over year. That's core CPI. 2.8 was previous, came in 2.8, forecasted 2.9. So same as before. Month over month for core was less than previous and also less than expected. The month over month headline, 0.2 forecasted, came in 0.1. Previous was 0.2, and also headline year over year. Previous 2.3 came in 2.4, which is slightly higher than previous, but forecast was 2.5. So, markets are slightly down today. They just turned around 1:30 p.m. It was actually a pretty quiet day overall. I still go back to how important this trend line is. Let me go to a slightly higher time frame. This takes us back to basically some pretty good price action starting in the first part of May. After all the April volatility, after the right side of this trend line breaking, this is what makes trading pretty simple. If you are on the left side of the trend line, don't fight it. Okay, we had a little bit of a fake out here, pulled back past support. Past support became resistance. Market sold back off. Liberation Day, all hell broke loose. We bottom out, we pivot hard. We go from basically trying to break the markets, trying to cause a global trade war, to then pivoting hard to now we're going to grow our way out of this thing. And, trade war narrative shifts aggressively and the market is up. So this has been one of the biggest volatility crushes in history. This is third best all-time recovery since 2008, 2020. Those are the only other times we've seen the market go down as fast as it did and also recover as fast as it did. This is third of all time, and that was with essentially COVID and a great financial crisis. So not to say that this was that, but it certainly rhymes with, oh my gosh, 20+% in the S&P, 27% in the Nasdaq, all within a peak in January, February, but a bottom April 7th. We had a lot of that decline starting just in the very first part of late March and early April. So anyway, I'm just saying this for the trend lines because look at what we have here. We have this low, we have this low, we have a series of lows over here. That price is dancing around, still providing support. But if this trend line breaks, we could probably take this one more trend line out and it will look something like this. Connect the lows from April 7th into this pullback low here. And that's going to run us, pretty much right in line with where prices are at. So are we starting to roll over on this trend line? Maybe. I wanted to take these lows. So take this low here, take this low here, take this low here, and see if price will hold. There's room to potentially fall and correct. I still look at this gap. That is the U.S.-China trade agreement gap. So we still have room to fall back to like 58 or 5,700 for that fill. We pull back to maybe equilibrium where this is a large low. Clean your mic. What does that mean? How's my audio? Is my volume like really, really high? Or is it just because my voice sounds like I have a cold? Because I do. Or had one. What's up with the mic? I just turned the volume down a little bit. Let's see. Give me an AV check. So lows here, lows here, lows here, lows here. This is why I'm watching this trend line so closely. We have all-time highs not that far away, about 1.7% to get back to these all-time highs. We are down in the day 0.5 for the S&P. We are down 0.56 on the Nasdaq. I think we're almost flat on the Dow today. 0.2 on the Dow to the downside, 0.5 on the Russell. Volatility is up just a little bit, 4.2%. Bond volatility, let's go move index on the, let me just go back to the SPX here. SPX, let's go back to bond volatility. So the move index here, Nothing too dramatic. I mean, bond volatility has decreased quite a bit since the peak in April, which makes sense. Volatility here, I'm looking for any type of elevation in volatility. I might end up adding some exposure on SVXY. Dollar index just kind of beating his lows up a little bit to the downside. I'm watching for a bear trap. I don't think this is going to necessarily break and go lower. I think that the break and go lower would come with much worse consequences for the U.S. I think we have a break in the bond market, or we have to have basically the U.S. economy rolling over into recession for the dollar to get super weak. So don't be surprised if the dollar finds a low and then ends up trading in a summer range. Perhaps that low is right around the corner. Watch for some fake outs here around that 98 handle. We'll see if we end up going from 98 back to like 102 on the dollar index. Oil making a nice clean break to the upside today. Let's see if this resistance is going to hold. This is a 200 moving average. So do we hit resistance here with the moving average like we did so many times before as we're making lower highs? This could still be pulling back. So if you draw a trend line, connect the dots here, something along this area. Is it possible to get back above the 200 moving average and then come back down? This also begs a question with inflation. If energy prices are going up, I think inflation starts to go with it. We've already seen, if you look at Trueflation, that third-party metric, we've already seen inflation go higher from the 1.22% lows. Here's the lows. This is pre-Liberation Day, or I could take that back. Liberation Day was April 2nd, but right after Liberation Day, we were down to April 6th, a 1.22% reading on this Trueflation inflation index for the U.S., and we are back up to 1.94. We peaked up here recently around 2.10. So, I mean, our CPI news that came out today wasn't dramatically higher, but still sticky. We're not sub 2%. We're not hitting that 2% inflation goal that the Fed is adamant about getting to. We'll see if the Fed pivots into like accepting a 2 to 3% range, which we are below 3%. That's not a bad thing. Headline inflation at 2.4 after this year-over-year print, and the core CPI is at 2.8. So, I mean, we're still restrictive. We haven't cut rates. We're like the last central bank that's going to be cutting rates this year. If we cut rates in September, if we cut rates in December. And that's the big argument between Powell and Trump. Is Trump says cut rates, Fed says we're staying put. There's arguments that the Fed's going to be too late. They usually are. They're always reactive. But are we needing to cut rates within 2% of all-time highs? Do we have to cut rates? I don't know. I don't think we do. I mean, if we do cut rates, the risk is that inflation continues to go up, that these tariff measures are going to be inflationary. We just haven't seen the real effects of it yet, and therefore the Fed is staying very, very cautious and also just letting data roll in to make sure there's no major shocks and surprises to the system. I don't think that's a bad thing. I think them staying put and being firm on just making sure that inflation's under control. I mean, look, inflation would be a much it's either going to be like a slow death for everyone in America over the last 4 or 5 years. Everyone's felt the costs and hidden increases of inflation, where everything, including life essentials, splurges, whatever, everything's more expensive. So if we have kind of a phase of stoking inflation, if we get to like a little taste of hyperinflation, I mean, again, you're just going to have a super upset voter base that it just wants everything to change. That pendulum can swing in a very extreme way. There's consumer choice, and people can just stop spending. Obviously, that's a big part of a GDP. So the potential waterfall of negative consequences of just having a recession that we're clearly trying to avoid, we're clearly trying to dodge. The percentages of of probability of recession this year have been up as high as 60+%. They've cooled off a little bit down to about 30-40%. I still think in some way, shape, or form, there are parts of the U.S. that are probably in it. I think there's still parts of Main Street that feel it. And anyway, I mean, I don't think the Fed is wrong for staying put. I just hope that our idea of growing through this like $2.4 trillion tax bill that possibly is going to be passed by early July, we'll see how the markets react to it. I mean, I think if you own assets, it's a good thing. If you expect the market to melt up higher, it probably will. I'm still hoping for a bit of a pullback. I thought would be an interesting thing today is to look at some of these recent pullbacks and how price behaves on the recoveries. So let's actually go back just in the last couple of years. This pullback here was, I want to say, 5 to 6%. So this trade here was a pullback of around 5%. Well, once we got back up to those highs, what did price do? We chopped around, got back to the highs, and then we fell. Look at this last correction we had last summer. So this would have been July to August. The market was down almost 10%. So look at that pullback there around 9.9%. We came ripping all the way back to the highs. And right when we got to the highs, we just pulled back again. And then we broke through them. So I think this is just a larger scale where we have a, pull back, get to those highs, pull back again, and then we have to kind of let the bulls and momentum clear the highs for a new leg higher. I could see this working the same way on just a much larger scale. This was a 10% pullback, rally back up, pulled back, rally back up, use this past resistance to become support a couple of times, still offered some higher highs. Okay, so on a bigger level, we have this high, we have this low. After this little pullback, I measure the head and shoulders, I measure the cup and handle, I measure the symmetry. That's what these lines are for. This is swing symmetry, this is cup and handle symmetry, and we're very close to hitting it. So if we hit this level, I don't think I'd be surprised to see that when price reflexively comes back up to these pullback highs, that the market stalls. So let's say that we get up to these highs, I could see the market stalling, right? Pullbacks 3, 5, 7, 8, 9, 10%. Could it be worse? Maybe. Worst case would be a 2015, 2016 range, which is we have this high, we have this low, and the market decides to roll over and then sell off and sell off and sell off all the way back down to the lows again. I don't think that is the case. I think the agenda has shifted very aggressively since April, but I do think that in order to accumulate some additional momentum, I think the market's going to have to pull back, offer up a dip for smart money, probably offer up a dip for institutional money, rather than them participating at highs and trying to take this thing higher. So I think there will be a pullback. In a way, I hope there is because I want to position for it. But let's just go back a little bit further. Same thing happened here. This was the high in 2023. We had about a 10% correction in July to October 2023. Again, at the highs, price just paused, right? We go up a little bit higher, we paused again. It was just kind of a slow grind, and all of a sudden it took storm. End of the quarter into 2024, the market started to rip aggressively. Getting into overextended conditions, and we had about a 6 or 7% pullback starting in April of 2024. So, reflexive move, pause at the top. Reflexive move, pullback at the tops. Here's another one. Fall, push back up to the highs, right? You see, this is just price action. So we fall here, we push back to the highs, we go sideways. We fall here, we go back to the highs, we go sideways, we actually come back down again. We fall from, let's say, this level back up to the highs. Resistance. That lasts a while. That kind of bottom here. We go sideways for 5 or 6 months before the market clears the highs, gets the new highs, uses higher lows and higher highs. Let's go back further. There's a lot of examples like this. Okay, here's a tricky one. We have a flush here. We go to these highs and we come all the way back down to fresh lows. That was the end of the bear market in 2022. Okay, so look at this. How did price behave at the highs, right? Let's just take this whole thing in 2022 as one big correction. Well, obviously it wasn't a V bottom. It wasn't a straight up move. It took time to build through that deleveraging. By the time we got back to these highs right here in 2021, this would have been November, December 2021 for the S&P. And actually, no, it would have been about January 2021 for the S&P, November of 2021, November 2020 for the Nasdaq, January 2022 for the S&P. That's when it started. Once we got back to these highs after taking 2 years, we actually ran through them pretty nicely. Let's go back again. This is a good kind of V bottom. This is COVID. COVID kind of behaved the same way. We had a reflexive move all the way up, little pause near the high, all the way back up to the highs, pull back, another pause, right? So even with today's price action, I think a pause or a pullback is likely coming. Okay. So just be ready for that. Same thing over here. Correction, gets back up to the same highs again, goes sideways. Eventually the bulls take over and break new highs. So I just think we need to be patient in and around these new highs. A correction is likely going to be the play. I'm not necessarily bearish for that correction. It could be a 3% pullback. It could be 5 to 7 to 10% pullback. Let's say that we get back to we get back to highs. Let's say we pull back to this U.S.-China trade gap. That's a 7 to 8% correction. I mean, I think that technically would be great to offer up some buying opportunities in here. I don't know if it's going to come fast or slow. I really don't. Does it pull back to just a simple like 50% range? We have this low, we have this high, we have this low. We go back and test the highs again. Do we pull back like halfway? Maybe. So between like the U.S.-China trade agreement gap to maybe the halfway point of this low to high swing, I would say between like 5,700 and around 5,500. That's where most kind of smart money would be waiting to accumulate some ownership of the S&P, or at least buying a dip. Okay, Zeus, I'll take a look at that euro. What is wrong with my mic? I don't know what everyone's talking about here. Donna, give me some feedback on my mic. Crackling sound coming from my mic. And I can pop it out, pop it back in. I can try a different mic. Could be just a weird connection. I don't want to lose the mic during the session though. Static. Okay. I'll let's see. Let me find another USB. Give me a second. I'll find another USB. All right. Testing. Good. No static. All right. Give me a quick AV check if we're back. All right. Let's continue. I'll look for some comments here in just a second. Maybe there's a little lag. So anyways, that makes sense on the rips. I mean, we come back up to these highs, getting a pullback. I think a pullback would make some sense. So do we hit all-time highs? Do we float at all-time highs? Do we pause at all-time highs? Do we pull back off these highs? This is what I'm waiting for. I mean, my crash insurance masterclass, I wouldn't mind taking a small trade here that gets us back down to this trade agreement gap. That could be pretty cost effective. I'll probably throw a trade in there, maybe a $250 to $500 risk that pays out, 4 to 1 or 5 to 1, make a couple bucks, and weather the storm with a bit of a pullback. Okay. All right. Very good. So that's SPX. Let's go NDX here. See what old Benji's up to. Come here. Come here. Up. Okay. What the heck happened there? NDX. So my cup and handle symmetry has already been hit. So we have this low to high. There's your cup line. If you measure this low to this high, okay, measure this low to high, that's the projected move. So we've actually hit it. A couple things you could be watching for. This is just a simple pattern trade, would be a rising wedge. So watch this level here, connect the lows. We still haven't broken this trend line on Nasdaq. Connect the recent highs. It could be as shallow as this, okay, or it could be as shallow as this. So I mean, I wouldn't be surprised to see bull traps at the top if the market pokes up here, hits the highs and then sweeps back down for a little correction. I don't think anybody would be shocked to see that. As far as technical analysis goes, I don't think anybody would be surprised to see a bit of a correction there. 5 to 7%, come back and fill that gap, and then we go from there. Maybe this is a new spot to establish some bullish positions, and we'll see if we truly grow our way through this, whatever you want to call this environment. The monthly time frame, We had a heck of a run from 2019, 2020, 2021. The S&P was up over 95% in that window. Okay. After 2023's bull market, 2024's bull market, currently we're essentially flat on the market. So here's year to date. We go sector year to date. I think we might be up 1%. Yeah. Year to date's up 2.67% after a 21% peak to trough. We were up as high as like 3-4% above all-time highs where the year started. We obviously dropped from peak to trough 20+%, and here we are 2.67 on the year. So are we going to have, let's say this gets into double digits. That's a pretty good run for 3 years. If you have 20+%, and then another 10% year, that's roughly 50 to 55%. It's more than that. It's closer to 60% for a 3-year stretch. Is it possible we have another 15 to 20+% year? Maybe. That's a heck of a run. That's a heck of a stretch. That would be the economy running pretty darn hot. That would be stocks running pretty darn hot. Despite a, tax bill, despite a spending increase, despite a debt ceiling, fiscal cliff that just continues to mount and get larger and larger. I think it's a pretty safe reality to say that the government can't stop spending money. The idea of coming into this administration with austerity and people supporting it and watching how it nearly broke the markets, or we caused what was pretty noticeable to me was systemic risk. And I just think that we're pivoting hard into like this growth agenda. So I don't think selling stocks is the way to do it. I think that buying the dip is the way to do it. I think ultimately, if anything, John Maynard Keynes' famous saying, the market can remain irrational longer than traders can remain solvent. I think holding through and trading through either right now just a choppy, indecisive, uncertain market, or trading through a potential global asset bubble, I think that's going to be more beneficial than trying to go head in the sand, fearful, trying to sell the market, be a perma bear. Perma bears have been crushed. They're right every couple of years for a couple of months, and then they're dead wrong all over again. And yet they dominate the narrative. When people are concerned, it's like they get all the clicks. They get all. I just watched a video today, and it was a social media manager, and his saying was, "Enragement equals engagement." So if you can make people scared, mad, upset, fearful, uncertain, it gets clicks. People are curious, Anyway, I think the best action is you got to trade through this stuff. You got to give the market its fair due. It's likely going to be a melt up. It's likely going to be something that doesn't get stopped. I don't think a top is necessarily in at all. I think if anything, this just sets up for a pullback to then higher highs. If we're lucky to see the pullback. Otherwise, if we have a little bit more of a melt up, does this area offer some resistance to become support, and this just keeps going? I don't know. Could it pull back a lot further? Sure, we could pull back into this area. We could pull back even lower. It could, heck, we could even pull back to April lows. It still wouldn't necessarily make me a bear. It'd make me want to protect things and make me have my hedges, which is why I have them out to, the end of this year. But if those hedges are worthless, where they don't make me money, it's like I'm still making money in the upside. Like right now, my previous highs were 195, then to 205, then to 230, then to 240, then to 250. This week I'm up to like 285. So I'm still seeing fresh highs in the portfolio as a byproduct of having a bit of a tilt. I've got a positive delta in my portfolio, so that is helping. And any pullbacks, I'm hopefully going to be able to see a few hedges that offer some small profits in the wake. But if not, those are worthless. I'm sacrificing about 1% to hopefully see maybe another 3, 5, 10+% to the upside. And like I said, this market can remain irrational longer than traders can remain solvent. We've seen it. We know it. Don't call the top. This market could go to, let's just talk S&P numbers. This market could go to 6,500. This market could stretch out to a new level at 7,000. All this would be a crazy low to high run. The reality is the year started right here. So the year starts right here. What does that look like for, what's the typical S&P average, by the way? About 8%, right? So when we started the year right here. Let's go to a weekly time frame or monthly time frame. Here's a monthly. Here we are back in January. So this candle that I'm highlighting, this is where January started, okay? Let's just say we go up. From here, the market dropped down during April. Oh, I got to go even lower for that April candle. The market dropped down from the open of that monthly candle. The market dropped around 18.05%. Okay, so we dropped 18%. Now, a typical risk-adjusted return for the S&P is down 13%, up around 8%. So we had a little bit more downside, but which means reflexively we might have a little bit more upside. So maybe this year can stretch out to an 8, 9, 10, 11, 12% to kind of match these averages with the risk-adjusted returns. But let's say that we get from this level, we had a 18% drawdown from the start of the year. Okay, what is a push up to like 8%? If we're up 8% for the year, that puts us at 6,370, roughly 6,400. If we go up 10% for the year, let's say we get double digits. Okay, we're up to 6,500. I think 64 to 6,500, just from historical levels of the S&P return-wise, 64 to 6,500 could be hit. Okay, I wouldn't be shocked to see that happen. So, do we have just more melt ups? Do we have a little bit of a pullback? I'm still going to position and basically plan for like a 64 to 6,500 move. Okay. How do I do that? Well, I mean, if we have pullbacks, I'm going to position a lot of trades back down to April levels for income, and I'll probably just dollar cost average into this area in case we do go to 64, 65, because that run would hopefully give us a double digit move. Let's say we pull back to that trade agreement gap. So around 5,700 or so, right? We pull back to 5,700. Still hit my 64 to 6,500 zone. That's a 11 to 13% move on the index. There's a lot of money that can be made in that position, right? A lot of debit spreads, a lot of credit spreads, a lot of positioning, I mean, if I allocate a chunk of shares and I'm selling calls, like just sell it, create something. But I think that could be a destination for the rest of this year. Muhammad says if it gets to 7,000. I mean, sure. I mean, but there's no stopping. Like 7,000 doesn't mean anything. I mean, what if the Fed is accommodative? What if it is pro-growth? What if AI is truly causing such high profit margins? Maybe this market goes like parabolic. I don't think it should or will, but it's like, I mean, don't just call the level and short it. I mean, I want to see overbought conditions with lots of divergence on higher time frames, a lot of alignments, draw some trend lines, get some clean price action, watch things roll over. Then you get a bear market. It's hard to anticipate a bear market, or if you are, do it with options, right? Okay. There you go. Yep, read a guy a couple months ago, Nick's channel, swore the markets remain bearish till 2028. Yep. Yeah, I mean, look, you can be that guy. You can be that trader, but you're probably going to be wrong. I mean, you look at this market for 90 plus years, it finds ways to go higher. You're looking for the modern market the last 70 or 50 years, finds a way to go higher. Look at since electronic trading, the last 30 years, finds a way to go higher. Like companies that make money rise to the top, get bigger market cap, and SPY goes higher, right? You get exposure to the top 500 companies that are always rotating. Who is best, who's the most competitive. I mean, right now it's like there's force buying in the market. There's the acronym is TINA. There's no alternative. It's like if you're not invested in the market, you're just watching money, like you're losing purchasing power and watching money get debased. It's like those that have assets, or I mean, this look, I know we're trading this, but it's like if you own shares of something, you technically have assets. So assets appreciate. If you're in the stock market, that has always been a historically good hedge against inflation. We've had historically low inflation for a while, and this like subtle 2% thing that everyone now cares about. It's kind of always been there. Now it's just things are more expensive because we have I don't know if you've seen this, but like since I don't know the time period here, but basically for the last like 20 or 30 years, we're like 11 or 12% higher than the 2% inflation. Like if 2% inflation ran like this in a straight line, our real inflation numbers are like way up here. It's like an 11% increase. So we're like 11% more inflated than the 2% target. This is why it stings. This is why everyone complains. This is why life feels more expensive. This is why life is more expensive, because that's where we are. I'm not sure what time period that is, but We've had ebbs and flows, but we are way, way, way outstretched from what the inflation trend should be. And I think ultimately, like, this is Powell's most likely legacy is like, don't have to be a Paul Volcker. Don't have to raise rates to 8, 9, 10% to smash inflation, and obviously throw this market and this economy into a pretty awful recession if that was the case. So we'll see. I mean, rates haven't really done much other than stay sticky. They're not really going up, or they're kind of they're higher than Liberation Day, but they're not pacing higher. It's not the rate of change that's shocking the market like it did during Liberation Day. Are yields going to continue to grow? If yields go higher, what's that do to bond prices, pushing them lower? Right. So if yields go lower, maybe bonds get a bid. That's going to be the next thing. So we can look at TLT catching a bit of a bid off this recent low. You can go to ZB for bond futures. Okay. So are we catching a bid here? It looks like it. But I mean, if you look left on the chart, I mean, we've got a 2023 low. We've tested this level many of times. Here's May of 2024. Here's January 2025. I think this is the big concern is, are we going to hold this low? I mean, I think it's pretty important to hold the low. And another thing would be if this pops to the upside a little bit, then that probably pulls equities down as well. So we could have yields drop, bonds rally, equities take a bit of a breather, and then this probably gets shorted again. I mean, if you look back on bonds for the last 4 or 5 years, I mean, this has just been a savage bear market. It really has been. I mean, from this peak here post-COVID, I mean, this market is nowhere close other than time. Time is now looking like, oh, I think we're breaking the trend line. Maybe, right? But if all we do is print more money, if all we do is, we're causing more like nationalistic isolationism, I don't know why countries would want to invest in the U.S. when they can invest in themselves. They can repatriate their own dollars. I mean, if you looked at an ETF for Spain, Portugal, Italy, Austria, you look at Mexico, you look at Latin America, you look at Brazil, you look at China, you look at India, you look at a lot of other countries. Their ETFs are taking off this year in a big run like we haven't seen in a long time. Even through the April pullback, they are ripping higher, and the U.S. is up 2%. I get it. Like, there's a lot more liquidity. The U.S. is a big bad market, and it's pretty dominant. It's pretty awesome, but it doesn't mean it's perfect. So I think we, at best, we maybe have a range here in bonds that kind of show stability. But I don't see a big raging bull market, and I would hope, for the sake of the overall economy and the global economy, is that the U.S. bond market doesn't just turn to crap, because I think that has major consequences for the dollar. I think that has major consequences for the U.S. economy. That would be tough. So it really is like wait and see, and that's why this uncertainty is so high this week, or this year. 2025 has caused a lot of uncertainty. Okay. All right, let's take a look at some currencies. Let's go currency strength. So top of the hour, I'm doing a pinch point masterclass again. We have another live session. I priced out some new trades today. I took 2 of them, and I've got 2 pending orders. We've got 3 trades that have closed out for winners. We had a winner today on Starbucks. So BSX is profit, Starbucks is profit, ASTS is profit. We have some others that are running for profit in the 20 to 30% zone. Setting those take profits around 50%. I've got 2 trades on today, COHR, and the ticker is GO. So COHR is one, GO is the other. I got into those for some fairly priced debits. We'll see what price does. I'm just setting my take profits and letting the rest happen. So we'll have another class at the top of the hour, and we'll take another look at the scan and see what's popping up. Okay, Dean, how'd you do today? 1:23 p.m. made the bucks. Good. That's good considering we're about 30 to 32 points lower than the open today. That's good, even with this little dip. So when the market's dropping around 2, I guess you got out earlier than that. So before the market started to drop a little bit from this 2, it's around 1:30 to about 2 o'clock. That was a pretty ugly 30-minute window. But anyway, good stuff. So currency strength today, Euro on top and Aussie, New Zealand on the bottom. We've got the pound, the dollar, or the pound, the Swiss, and the yen just above baseline. The dollar and the CAD we've talked about this for the last couple weeks. I mean, we're seeing the Japanese yen and the Swiss franc move pretty much the same. So their safe haven flows are, they're both strong one day, they're both weak one day. We're seeing the dollar, Canadian dollar moving together. So the US dollar and the Canadian dollar moving together quite a bit. The Aussie New Zealand trading together quite a bit. This is kind of crazy. I mean, I don't see a lot of this. I mean, I know that, China has a big influence on the Australian dollar and New Zealand dollar. Risk appetite or risk off trading. I mean, we see that with inflows, outflows, but it's weird to see this year, like Japanese yen, Swiss pretty much lockstep with their day-to-day price action. Dollar and Canadian dollar pretty much in lockstep with the day-to-day price action. And again, volatility is pretty quiet. I go back to the charts. Let's go into currencies. So here's Aussie CAD. I'll go to the daily chart. I'm still waiting for a pullback at my 5.0 to 618 swing. Aussie Swiss, I'm waiting for a pullback, same thing. I'm looking to kind of buy this area. Let's see if we can get back up to this 200 moving average. Aussie yen, no trade. Maybe on the right-hand side of this, maybe. Depends on risk on flows. But if this is, a trend line break, pullback, maybe something like this. If it breaks above the 200 moving average, we have range highs. That would be risk on trading if you ask me. So if we see it, that's a pretty good lineup. Aussie, New Zealand dollar, just waiting. Aussie dollar, kind of the same thing. I don't really want to buy at 6,500. I want to get a pullback to 64. I want to get a pullback to 63 or 62. I like those trades a little bit better. CAD Swiss, still waiting for a push up into some of these bigger support levels at 62, 62.50. Maybe these highs in this pocket all the way back here towards 6,500. CAD yen, nothing. Swiss yen, they're pretty much the same currency pair, sideways. Euro Aussie, we'll keep an eye on this one. I was wanting to buy this one low around the 144 to 200 moving average. It's not there. I was considering a sell trade up here, but it's like I wanted to sell trade when we first had like our April top. I wanted to try to get like a 5.0 618 swing. That's months ago. So I don't think I'm going to do much on this one other than just kind of sit it out. Aussie CAD, maybe watching for a sell trade up here at the highs at 5,900 to 6,000. Seeing a price rejects off of that. Euro Swiss actually behaving pretty nicely. My Euro Swiss position, I'm down a little bit. My break evens around 94.90. I'm trying to get this thing up to 96.50. I'd love this thing to get back to this pocket area between 98 and 99. I'd like to be able to hang on to it that long. Euro pounds, no trade. Euro yen, kind of breaking these recent highs. The best trade was trading down here at the support levels back in February, March. Euro New Zealand, obviously some equal support. If you're buying low, stop loss out of the way, target the range highs. Maybe this thing just goes back and scores a point. It's kind of too late to do it now. You gotta watch your levels and convert that to a smaller time frame. Euro dollar, oh man, this is close. I still didn't get that chart alarm going off. What's the high today? High today at 14.99. I mean, are we stalling here? I'm up 200. I'm almost up 300 pips. I think I'm just going to close this thing. I'm going to close this. I'm going to close this trade. So 297. I had a take profit set at 15.50. So I'm just going to go and take this. This is good enough. 297 pips. I'm going to close it. So close that down for profit. I will cancel this trade, and that was it. So let me update that in my alerts. So that is FOREX trade management update. Euro dollar again is very close to 1.1500. My original take profit was 1.1550. With the 1.5 handle and close enough to my take profit, I'm closing the trade for plus 297. And I'll revisit this trade. I believe the DXY will be range bound and support is near. So I'm not trying to hold the euro dollar for longs. Okay, taking the winner. 297 pips on euro dollar, closing it out. Okay, so now if the dollar turns, let's say the dollar turns. Well, if the dollar turns and dollar index finds some support, that means that we're probably going to hit some resistance on euro dollar, and maybe there's a good shorting opportunity with a stop loss above that 116 handle. I mean, that doesn't seem like a bad trade. We either get back to the same low again, that's target one. We pull back a little bit deeper. Maybe this whole thing is a range bound trade back to like 109, 108, 107, maybe. But I could see this happening too. Swing, sideways, sideways, and this range becomes a bigger move later. Okay, that's again if the dollar is going to break that major support, which right now I don't think it's ready to. So I think we have like summer range trading. We could still tap this alarm. I'm going to set this alarm right at the highs now. I'll set this at 1550. There. That was my initial profit target, so I'll set it there. Pound Aussie, Pound CAD, nothing. Pound Swiss. I like long on this one. I just want to see if we get a pullback. This is likely going to make its way up into this little cluster. I said 1350 to be conservative, so 1.1350. If you're watching closely, maybe a breakout there. If it pulls back, that's fine. Wait for a trend line break. I wouldn't mind leveling in small, 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 and still trading it back to that pocket if it's offered up. Okay. The Nasdaq. I mean, we did that earlier. S&P and the Nasdaq are pretty much the same. The all-time highs are so close. We might just go up there, poke the all-time highs, and then have a bit of a turn. I was going through the session earlier, just talking through like all these pullbacks we've had. Market, has a 10% correction, gets back to the highs, pauses or pulls back. Market has a 20% correction, gets back to the highs, pauses or pulls back. Kind of the same thing here. We had our correction. We're melting our way up towards those highs again. We pause, we pull back. So, I mean, the trend line is pretty simple. This is the S&P right here. If this trend line breaks, I think this market rolls over a little bit, but the all-time highs are just, like 1.7% higher. So it's not that far away to poke them. And then the Nasdaq, you can do a very similar trade. We've got all-time highs here back in February. Just barely in February. And I would probably draw this trend line, either connecting. That's a little tighter. I think I'd go out. It's close. I mean, probably this trend line here, something like that. This one's not perfect. There's just a tiny bit more volatility on the Nasdaq, or actually the Nasdaq might be a little bit simpler to do something like this. Just start with the April 7 lows. So one of two trend lines on the Nasdaq. We either have this low here, okay, which clearly hasn't rolled over yet, or we have this from these recent lows, something like that. So if the Nasdaq breaks through those trend lines, maybe a bit of a pullback. If you're looking for a top, then look left on the chart. There's your top in area, like just off of those all-time highs. So we have a low right here, a low right here. Does the market poke the highs, sweep the lows, and then we have a bit of a correction ensuing? What we always have to wonder is like why, right? Why? Well, maybe there's some drama around the 90-day pause with the tariffs, trade war, right? Maybe that's part of it. Maybe there's something with the Fed. Who knows? End of the quarter. Maybe it's all kind of rolling out that way. Maybe the Fed says something next week that the market doesn't like to hear, right? It could be any like myriad of reasons. It's just what does the market grab onto, and run with? Do you think the big beautiful bill could breach the U.S. debt ceiling? I mean, Lee, is that even a thing? Come on, man. You know how we do in the U.S. What debt ceiling? Raise the debt ceiling. There's no debt ceiling. I mean, basically, Trump is agreeing with Elizabeth Warren, like total opposite views to agree on basically eliminating the debt ceiling altogether. So every time we come down to this debt ceiling debate, what do? Congress pats itself on the back for some, we had to stay until midnight and we had to have coffee and hang out until, the 11th hour to do what? Raise the debt ceiling. It's like, we all know what's going to happen. It's drama, it's all noise, but what does the market ultimately get? Raise debt ceiling, the U.S. doesn't default, and off we go. Just a bunch of noise. So I'm if the debt ceiling was truly a mess, we would have had a lot more defaults in the last 15, 20 years. So No, I don't think it's going to. I mean, I don't think it's going to matter because even if we, create a tax extension bill that raises the deficits by $2.4 trillion, we're just going to raise the debt ceiling. We're just going to add more liquidity to the system. That's what the U.S. government's good at. So, and again, that's the problem, but it's not going away. Okay. So anyway, those are my levels. Watch your SPX. There's my trend line. Here's my NDX. There's my trend line. So I'm watching. We'll see how it plays out. Okay, back some currencies. Pound yen, nothing. Pound New Zealand, some equal lows. I was looking for that 144 to 200 to buy this thing. I just didn't get it low enough. Pound dollar still hasn't broken the trend line yet. I mean, I don't have a trade in this one. I just thought it's interesting how it's been behaving off this trend line for a while, running from 2100 all the way up to 3500. That's an impressive stretch on the pound. Mostly just the dollar getting weaker. New Zealand CAD, a lot of chopping here. I do like this trade. Buy and buy and buy, and this is my target. I think this is a good trade. So I'm going to officially make, let me put in an order here around 8,200. All right, so I'm going to do an official order. I'm already long in New Zealand CAD, but I'm going to make an official order. So I'm going to go 8,200. And let me drag a fib here. So I'll go 8,200. And then I'll go 80. So 8,200 and then 80, 85, which is a 50% zone. And then I'll go to the, let's go 79.95. So the stop area would be around 7,800. And the take profit would be based on a symmetry swing, which I think we just go up to this high. Let's just take this symmetry swing here. And let's say that we pull back to a 38% or a 5.0 or a 618. That symmetry puts me up around 8,500. So 8,500 would be my target. So between 85 and 8,550. Conservative. But if I can build this into like 1, 2, or 3 positions, I like the trade. Getting up to symmetry should work out pretty well. New Zealand Swiss, close to this 200 moving average. We've got a decent bar count. I'm still looking to see how this thing plays out to give me hopefully a price pattern that I can trade. New Zealand yen, no trade. New Zealand dollar. I'd like a pullback here towards 58.60. I just don't know if we're going to get it, but I'm not long. I was long in here. So I had buy and then 2 more buys, got out this level break even, and then 2 winners. I didn't take the equal buy trade. I did it on the Aussie dollar instead. So the Aussie ripped up 300 pips. The New Zealand dollar I stayed out of. But if we pull back here, I don't mind this trade. Open space. This probably has a lot to do with U.S.-China. I still think that China-U.S. trade talks, I see apparently we have a handshake agreement. Doesn't mean anything. I mean, markets haven't ripped on it. So is it just the markets have priced in that we're going to all get along and U.S. and China are going to figure something out? Kind of seems like it with this last like 6%. The U.S.-China trade agreement gap, the market's up 6% from that level. Okay, dollar CAD still leaking a little bit lower. I'll just wait. I'm not interested in this currency pair unless we hit like 34, 33, 3,200. Then I'll start looking for buy opportunities. Dollar Swiss, I'm looking for some diversions at the lows, right side of the trend line. I'm trying to get this trade back to this pocket right here. My break even is a little bit lower than that. It's around 8,500. So 85, can I get it back to 87 or 88? I'll take some profit. If we come back and stab the lows, I do have some buy orders right here. And then I've got some stacked orders on the right-hand side of the trend line. Dollar yen. Well, the only thing I'm really watching in the dollar yen would be if we have a big, ugly downside trade, which would be the break of 140 and the price target at 120. That's the trade. Until then, whatever, noise, right? Noise, 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 noise. Maybe it's range, but it's the 140 to 120. This would be a bad trade. Like this would be risk off trading. This would be really, really aggressive. Most likely, it'd be bear flags, and we'd either have another swift move with the weaker dollar, or we'd have a big shift in the yen with another kind of event like we had last summer, which was the kind of Bank of Japan deleveraging, and the markets ran with that in Forex, and we had some risk off tones. So we'll see. But I don't. If 140 doesn't break, then it's just noise. We might just chop around here from the 140 handle back to 148 to 150, maybe higher, but that's all. Okay. What else is going on? That's it. Schiller price to earnings. What's this one here? Consumer price index, purchasing power. Yep, in the toilet. Let's go gold, silver, Bitcoin. Gold is at 33.47. I like consolidation. I'm hoping I can accumulate at better prices, maybe 3,000 to 2,800. Silver, I think silver remains a buy. I'm still interested in buying these dips. So somewhere in here on silver looks pretty good to me. If we have that pullback, I'll probably look at the futures options market to add some income. So if we pull back into this area, I'm probably looking for like a 1-1-1 trade down here on silver futures for higher lows. Higher lows, higher highs, higher lows, higher highs, but try to position it so, as long as silver, like silver futures, don't go below 30 or 29, I generate the income. So maybe adding some silver futures exposure. I just have shares of SLV right now. I have shares of GLD right now. I want to get a better trade if I'm going to add to them with futures. Bitcoin still haven't clicked the highs yet. We had recent highs at 112 and change, and we're just shy of those highs. Let's see. Maybe some gaps, maybe a turn. Copper, yeah, making a nice turn here. Where's that copper trade at that I have? So I have a trade on copper, expiration June 25th. I'd love. I mean, I'm up $50. Okay, that's all. Let me see if I can close this thing down. I might just take the profit here. So I got in for 0.0040, and I get out for 0.0060. Let me see if I can get a little bit more profit. This would be lucky, but so not filling there. 6.5, 6.25 or 6.0. What does this give me? About $150. I'll try it. Not filling. All right. Well, it's not going to fill, so I'll let it run. Max risk on this thing is $90, and profit potential is $1,400. So I just thought if I can turn $90 into $90 or $180 or more, then I'll start looking to protect it. But I'm up $50. I thought I'd take a stab at it. Didn't close, so I'll let it just marinate. Okay. I think that's going to do it for the final hour. I've got a pinch point masterclass in just a few minutes, so top of the hour, 4 p.m. And then I've got a couple private workshops stacked up for today. Anything else? Any other charts, questions? Oil's up 5% today. Yes, it is. Oil, and like I said, oil is potentially this narrative where, I mean, again, oil has been in a bit of a bear market since the top here in 2023. So, I mean, I guess you could say bear market when we are making lower highs and lower lows. Is this another run into resistance where this market hits resistance and falls back down again? Maybe, right? I think we have some legitimate concerns if oil is up here and it stays here. If oil is up and it stays and it catches a bid, I mean, part of the reason that oil could catch a bid is because everybody freaking hates it. Everybody says it's bearish. Well, that's the perfect squeeze, you know? So, yeah, we'll see. But I do think that this will make the inflation story a little bit more difficult. This will prove the Fed right if they don't cut rates. It's probably a good reason because you're going to see energy prices going up. You're going to see, trueflation probably poking higher. So if this goes up with energy prices, I don't think the Fed should do anything with rates. What does that do? That certainly makes growth struggle. So this whole idea, this whole agenda of pro-growth, we'll grow our way through it. AI is the future. We got to build it out. So, I mean, there could be a bottleneck to that growth if we have higher energy prices, higher inflation. And nobody wants to say it, but stagflation is a very real thing. If the S&P is only trimming, or single-digit gains, and inflation is 2 to 3%, 2 to 4% range bound, or maybe going higher, I don't think that's a strong environment for growth. So stagflation, even though nobody wants to admit it, it's like it could be what we're facing. It could be what we're in right now in some way, shape, or form. So time will tell. But oil, yeah, it's up. I mean, it's up, yeah, 5% today, 4.93%. I just say that it's not been a believable squeeze. It's been a squeeze, but it has not been sustainable. So what do I need to see for oil? I need to see this thing stay up here, pull back, and then support needs to hold. Then, buying the dip on oil, like maybe this gets back to 80, 85, $90, right? But maybe it also pokes right above the 200 moving average and comes right back down. And it's no better off than where it already started. At the lows, lower highs equal lows, or maybe even still channeling. Maybe, a lot of manipulated price action on oil. So I tend not to trade it unless I really have a clean trade, which right now I do not. So, okay. Let's wrap it up there for the final hour. Just a couple minutes for the close. And I'll let you go. Pinch Point Masterclass in just a couple of minutes. I'm just going to go refill my beverage. And we'll jump in and take a look at some fresh scans today. So I think we have some fresh scans. I'll show you real quick. Let me pull the scanner up. So if you can get a quick peek before the close, we have 2 minutes. Here's my pinch point. We got 25 stocks in the go zone. So we're starting to see some more lineup. Like the get set is to me actionable. I'll take a look at some of these today, but go is where it's at. I mean, we've already had 3 winners. SCHW, is that a Schwab? SCHW, that's probably a Schwab instrument. Oh, that's the actual Schwab. Okay. Okay, we got a nice little pinch near the top. I'll take a look at that one today. So that's new. Some of these we've already priced in. COHR, I'm live in that trade already. I priced out. Let me look at it today. I priced out ADSK, didn't take the trade. Priced in DOX, didn't take the trade. I do want to take a look at PGR. That's not a pinch point. That's just a trade I looked at yesterday during the final hour. So anyway, we'll see if we get some new ones. Okay, so good stuff. We got some digging to do in just a few minutes. All right, buddy. I appreciate being here. Thanks for watching. Chris Pulver. So it's youtube.com/Chris Pulver. Like, subscribe, click the notification bell. YouTube.com/Financial Wars. Like, subscribe, click the notification bell. Lots of content on those channels. Check out my channel. I've got plenty of free content, trust content, lots of different asset classes, lots of trading, and check out whatever shorts, videos. Keep it seriously simple. Options 101, indicators, whatever. There's a lot of stuff on there. If you have any asks or questions, let me know. If you'd like to join my Telegram channel, it is right here. I post in this thing every single day. If you'd like to join my Discord, I can post that as well. So I'll just post those before I go. Telegram is here. So Chris Pulver, Telegram, that is for free. And I'll post a 30-minute link to my Discord just because I don't want it sitting out there on YouTube to potentially bring in some scammers and bots. So invite. This will be good for 30 minutes. First thing you do if you join my Discord is read the rules. I don't send direct messages. I don't send friend requests. Anything you're getting that looks like me, it's not me. If you want to contact me, I'm in the public chats all day. Chris Pulver Trading Discord. There you go. Okay, and we'll come back and give it a crack tomorrow. So pinch point traders, I'll see you in a few minutes, and everyone else, see you tomorrow. PPI data at 8:30 a.m. Another round of inflation for the U.S. tomorrow morning at 8:30. We'll see if the market's going to react at all. Okay, see you then. Thanks. Bye.